Thank you for joining Market News with Rodney Lake. This is a regular show of the GWII Investment Institute where we discuss timely market topics. I'm Rodney Lake. I serve as Vice Dean for undergraduate programs at George Washington University School of Business. Let's get started. Welcome back to Market News with Rodney Lake. This is episode 6. I'm your host, Rodney Lake. Let's get started. So today, what are we going to cover? We're going to cover the GWII Investment Institute Framework, BMPB, Business Management, Price Valuation, and Balance Sheet. And the focus for today is going to be around the business part of that. And so we'll talk about other components in other episodes. But today, we're going to focus in on the business and how an analyst, if you are out there thinking about analyzing a company, should look at a business. And what are some tools? What are some things to think about? We're going to review that. When we review these things in the Investment Institute, we score them from 1 to 10. So 1 being a company that not desirable and 10 being the most desirable company. So you can think about fantastic companies would be a 10. So for example, one of the holdings in our portfolio is Apple. I would say Apple is 10 or close to a 10. It's a fantastic brand. It's really well run. It has a rock solid balance sheet, which we'll talk to. But it's a fabulous business with good profit margins. And so when we talk about this, you really have to start thinking about the business. And so every day you should consider this sort of the Peter Lynch, what's in your refrigerator, and thinking about businesses. This is going to help calibrate what's a good business, what's an average business, what's a poor business. As an investor in publicly listed equities, you can really invest in anything. You don't have to invest in an industrial company. You don't have to invest in a software company. You don't have to invest in any of these companies. You can hold cash. There are consequences for that too. However, you really need to think about what you're investing in, what type of businesses these are. And if you're a fundamental investor, and that's the approach for the GWII Investment Institute, Ramsey and Phillips Fund, as well as real estate, you really have to think about, okay, what are the fundamentals for this company? What are the fundamentals for this business, first generally, and then specifically for the company I'm looking at? If the industry has high profit margins, maybe there's a reason for that. And if your company matches those margins or better, well, okay, then it's doing at least as good as the industry and possibly better. And if it's not, possibly there's something wrong with the way that they're running the company. So that opens up other questions, and we'll get to management in other episodes. But again, today, the focus is on the business of the BMPB framework. So just to give an overview of how we score this in our classes and what we ask our analysts to do at the GWII Investment Institute, again, 1 to 10, 10 being the best. And then we weight each component 25%, and then we come up with a composite score for this company. So that way we can compare one company to another, whether it's in the technology sector, the healthcare sector, and any sector. And so, but you as the analyst have to really put the time in to think about these things. And so what makes a good business? And so there are many things that make a good business. And so you start thinking about, okay, how do I evaluate if this is a good business or not? Let's use Apple. I talked about that as an example. So many of you out there probably have an iPhone. And if Apple raised the price on iPhones, let's say 10%, how many of you are really going to change to an Android phone? I would guess not that many. Maybe is it 20%? Is it 15%? Is it 30%? What is the point where you would switch? And at what point do you remain loyal? Is it 10, 20, whatever it happens to be? If they can raise the prices 10% or even 20% without you switching, that's something called pricing power. And if all else, ceteris paribus, things stay equal, all of that difference drops to the bottom line as profit. So they're passing along this pricing power because their customers are loyal. They've built a brand. They've built a following. They built this ecosystem. And the Apple is an extreme example because they're so good at it. People are very loyal. Once you have an iPhone and maybe you have a Mac, you really have a big disincentive to switch out if all your information and everything works and you enjoy it. Well, that is a good business, and that comes with higher than average profit margins. And so when you're looking at a company, you should be thinking about, okay, well, what are some indicators for a good business if I'm, really not sure how to start this? Well, you can start looking at profit margins. If it has a profit margin of 50%, okay, that's very good, right? And so you start looking around, what's a business that has a low profit margin in comparison? Well, you can pick any of the commoditized industries, whether that's oil and gas or lithium or anything that's fungible, meaning that, it doesn't matter what gasoline you put in your tank. It's really the same because it's coming from a commodity, in this case, oil. So if that's a commoditized market, there's really no brand difference. So you're indifferent whether you buy from this person or that person. And that doesn't create any brand loyalty. So there's no way to extract any economics from that. So the profit margins over time for those businesses tend to be lower. Now, you can still make money in the commodity business. However, you're not going to earn the types of return on invested capital that you would earn, let's say, in a software business or a software and hardware business like Apple. Then, some of that, you would say, well, some of that gets reflected in the price and the valuation. That's true. But over time, you tend to compound at better rates with higher quality businesses. And for our students, that's what we're aiming for them to look for. We're saying within each of these industries, go out and find the best high quality businesses. Of course, we want them well run by great management teams. We want them to be at least attractively priced. Sometimes we do have to pay up because they're good companies, but we also want a rock solid balance sheet. We want the balance sheet to help us sleep at night. So in general, net cash on the balance sheet or a very responsibly managed balance sheet. But back to the business. And so again, as an investor, you can really invest in anything. So you should be looking for these high quality companies. Look for characteristics that are high quality. So you can look at the gross margins and the profit margins to start with. Then look at, is there a history that this company's been able to raise prices and pass that along to their consumers? If that's the case, again, they have pricing power, which means that there is some underlying loyalty to the brand, to the product, both, because people value that and they're willing to pay up for that. Well, if the company doesn't abuse that pricing power, that's a fantastic asset over time, because at some point, customers may switch, right? I don't know what the extreme case is in Apple. I think Tim Cook and company has done a fabulous job of not pushing it to the extreme point. But other businesses to consider that have fabulous economics would be something like Amazon Web Services. So high profit margins on that specific part of the business. Amazon started as an online bookstore, and then AWS came about because they had excess capacity in their compute. Well, some of their clients thought, well, we could use that too, and they could sell it and monetize that extra capacity. Ended up being the highest growth business and now probably the most valuable part of Amazon. Again, great business. So why is it a great business? Because they're using that capacity anyway. They sell the excess capacity. You end up having high profit margins. And AWS, you could say that it could be commoditized, but when you really get at scale, the big players, if you're a government entity, the US government, for example, or foreign government, are you going to trust a really small player, or are you going to trust Amazon, Microsoft, Google to deliver these cloud type of services like AWS? Very likely you're going to want to go with someone that has the infrastructure that's to support not only to scale up your operations, but also to make sure you have the right security and infrastructure in place that helps you also sleep at night on the resiliency part, on the operational part. And these companies have that. Now, contrast that, again, back to the commoditized companies. And again, you can make money in these companies, but, we really encourage our students to look for these high quality businesses with these high margins, and hopefully we can sometimes get them at an attractive price. But I also encourage you, when you're thinking about a business, back to the Peter Lynch style, what's in your refrigerator, look at what companies are out there. If you go to Starbucks, Starbucks is a publicly traded company. So do you go in? Are you delighted by the products and the services? Do you think they're doing a good job? Do you think they're rolling out new products that are interesting? Do you think that they're doing a good job of sustaining the products that you enjoy? If that's the case, well, maybe it's time to look at them as an investment. Do you think that's a good business? Do they have lots of customers? Now, anecdotes only go so far, though, so that's why you have to do the research. Just because you like a particular product or you have a single good experience doesn't always translate across the board. So you have to do the work in addition to that. But it's super helpful to start paying attention to those products. The car that you drive, the car that other people drive. Most of those companies, if not all, are publicly listed companies for the most part. So you can look at a Tesla, you can look at a GM car. These are publicly listed companies. Do you think people are brand loyal? Do you think they have good margins? Well, that's when you start to get into the homework. And so on the business front, as an analyst, you got to really start thinking critically about how businesses operate, how they run their business. Is it a commoditized business? Is it a high margin business? And you should really be thinking about those aspects of the business. Other good businesses, right, that are out there, like Microsoft, has high profit margins because it's a software company. To talk a little bit about software, you can think about this just as a mental exercise. What's the cost to produce the next piece of software that you sell? The marginal cost is really zero. So that's why you have high profit margins. There is nothing to deliver but something in the cloud. So those businesses, again, software as an example, has really high profit margins because the marginal cost for the next piece of software that they deliver, especially now in the cloud, is near zero. Maybe it's not exactly zero because you have some infrastructure to support that, but that's an example of a fabulous business. And so you should really be thinking about the businesses that you want to be involved with. You should really be thinking about how those companies make their money, what are the profit margins, who are their customers. Another piece to think about is what percent of the customer's budget, let's say, is going to be made up from this purchase. And so, for example, a house or a car is going to be a significant purchase for an individual typically versus an iPhone. So even if an iPhone, for example, or a smartphone overall, but let's stick with Apple, is expensive, it's $1,500 or $2,000 or whatever the best model that you're looking at happens to be at the time. But what percent of somebody's overall budget is it? Even if they refresh their phone every 2 years, what percent of their budget is that? It's not a huge percent. And so that's something where you really have to consider, well, if you actually amortize that cost over the time period that they have that phone, it's really not that expensive relative to their overall budget. So possibly if they find great utility in having that iPhone and it's really useful for them, then they'll pay up because it's useful, it's valuable, it helps them do things, it helps get them through their day, it makes sure that they make their meetings on time because they have their calendar and their schedule and everything else on there. So you have to really think about the underlying products and services that are being delivered when you're thinking about the business. Another metric that I want you to consider as an analyst, if you're thinking about doing this on the fundamental research side, is return on equity. So in class, we typically use the DuPont formula, and I want all of our students to really think about the DuPont formula. And what is that? That's the profit margin times the asset turnover times the leverage in the business. So the equity multiplier, in other words. And so those three components help you really understand a business. So you can do a very quick exercise and say, okay, what's the return on equity for this company? You break it down to these three components. Well, does it have a high profit margin? Well, that tells you something about the business. So if it has a high profit margin, well, that's excellent. And it's very likely going to be a good business. Asset turnover, what's that going to tell you? That tells you the efficiency for the management team. Are they doing a good job for the business? Are they turning over the assets? And the equity multiplier tells you what is the leverage in the business. And so if all else is equal and the company has low profit margin and high leverage, well, maybe it has a high return on equity, but maybe that's not such a good thing because it has a lot of risk associated in the balance sheet. So when you're thinking about that, those three components, higher profit margin, very good asset turnover, and as low leverage as you can have it for the highest return on equity with the lowest amount of risk. So again, for our analysts, we're talking about how do we get ourselves involved with high quality businesses? How do we make sure that we're not taking excessive risk to acquire those businesses and hold those businesses? Well, this is a simple formula that helps you get started. It's not an end-all be-all. It has limitations, but it is a very good start. And the first component of that is the business, which is the profit margin. That metric helps you do that. So I think it's a critical formula to memorize even. For our students, I encourage them to memorize it. It is not a difficult formula to memorize. And you can quickly, again, make an assessment whether maybe this company is a pass, maybe I don't want to do any more work on this. The allocation of time as an analyst is a critical decision for yourself as well. So you have to think about, am I going to spend time on these 10 companies, these 5 companies, these 4, 3, 2, or 1? Well, the more time you spend on a specific company, probably the better you're going to know. So sometimes if you get to the point where you think, well, there's a lot of risk baked into this business, maybe it's just a pass. And we encourage our students to do that as well. If you're looking at a business, for example, and you cannot understand it, and you do a quick work on it for the DuPont formula, that might be in the too hard pile, as Warren Buffett calls it. Just move it over there. That's okay. Maybe you'll get back to it one day, maybe you won't. But after some effort of trying to understand the business that you can't really understand the business, then it's time to move on. And some, caveat, or let's say a qualifier there is, if you're looking at a chip company like NVIDIA, as we talked about in the last episode, It doesn't mean that you have to be an electrical engineer or a chip designer to really understand their business. Sometimes that can be helpful, especially in biotech companies, for example, but it's not necessary. If you understand who their customers are, you can understand the business if you spend the time to understand the components. And so I encourage you to do that. Another thing to think about the business is the customers. And so who are the customers for the business? Not just percentage of their budget, which we just mentioned, but who are their customers? Are their customers companies? Are their customers individuals? And so when you talk about a B2C or a B2B, sometimes each one has their advantages, but you have to think about what's the underlying dynamics. Who has, the leverage in that situation? Porter's 5 forces can help you do that, and we utilize that framework in class as well. So if their customers are, like we talked about in the last episode, Microsoft, Meta, and Google as an example, well, they probably have the pockets to support more, buying for their products. And so obviously that's an extreme example with NVIDIA, but you can look through and who are their customers. Do you think they're weak customers? Do you think that they're going to have trouble buying the next batch of products and services from this company? Well, maybe that puts into question the quality of their business because, well, they've attracted these clients, but to retain these clients and keep them going could be challenging and difficult. So let's work on wrapping up here. We talked about the framework overall very briefly, the business, the management, the price valuation, the balance sheet. We weight those 25% each to come up with a composite score, and we rate each one individually 1 to 10, 10 being the best. So when you think about a company like Apple, you're going to say, okay, that's a 9 or a 10. That's a high quality business that has very good profit margins, and people are very loyal to that. It has pricing power, and its underlying customer base is very solid, 1 billion phones installed and growing, and very loyal. So that's a very quick assessment about Apple, but that gets you to the 9 or the 10. And we'll talk about the other components, but I encourage you to do the work. Think about these businesses like Peter Lynch, what's in your refrigerator. If you go to Starbucks, if you take an escalator, those are publicly traded companies too. Think about, are they doing a good job? And maybe I want to investigate a little bit more, but put the work in. Put your thinking cap on. Start viewing the world as an analyst, and all that you do when you walk into Starbucks, you're getting good service, you're getting a good product. Do you enjoy it? Does it delight you? Well, that's a good place to start for new businesses and business ideas. Then you got to put the work in. Use the DuPont formula. I encourage all of you to have a great day and see you back at episode 7. Thank you. Disclaimer, the content shared in the GW Investment Institute podcast is for informational and educational purposes only and should not be considered investment advice. The opinions expressed in this podcast are those of the host and guest and do not necessarily reflect the views of the GW Investment Institute or the George Washington University. Listeners should not act upon the information provided without seeking professional advice from a qualified financial advisor. Investing involves risks, including the loss of principal. The GW Investment Institute, the George Washington University, and the podcast hosts do not assume any responsibility for any investment decisions made based on the content of this podcast. Always conduct your own research and consult with a financial advisor before making any investment decisions.